Hello and welcome to the World Built Environment Forum webinar series. First of all, thanks to Colliers International as World Built Environment Forum Premier Partner and to our executive partners Glodden and Shanghai Oriental Investment Supervision Company. Today's webinar will focus on the results of the latest Global Commercial Property Monitor, which have just been released, specifically looking at the feedback received from the Middle East and Africa. My name's Simon Rubinson, and I'm the Chief Economist at RICS. I'm responsible for managing the Global Monitor. A quick reminder, this survey is designed to capture sentiment amongst professionals working in the real estate sector. It typically receives around 3,000 responses each quarter, which is actually pretty impressive for a high-frequency questionnaire. Significantly, a number of the key metrics captured in the survey have been shown to be good lead indicators of hard data, and that's why the survey results are so closely watched by policymakers around the world. Now, I want to talk for around 15 minutes this morning and then open up the conversation to your questions and also to your thoughts, because the survey is built around gathering feedback. So I'm very interested to hear what those people listening in on this webinar are seeing in the market and what their expectations are. So let's move on to the results of the survey, and really you won't be surprised by the tone of the feedback that we've received from respondents. It's been pretty downbeat, reflecting the direct impact of COVID on economic activity. And actually, what's more, when we actually break the data up into chunks to look at how the sentiment has changed over the collection period, it's clear that as the virus became more prevalent in certain countries, that the feedback deteriorated. So it's a pretty consistent picture. And it's also pretty consistent with the broader macro environment. And you'll have seen a number of international forecasters talking about the global economy. You will have seen forecasters in your own markets talking about the national picture. For what it's worth, the most recent IMF analysis, which you may have seen, talks about a contraction in economic output at a global level for this year of around 3%. And actually, they pencil in slightly larger falls for much of Africa and the Middle East, not materially, but slightly larger. But these projections, as you might imagine, require Herculean assumptions about both the control of the virus as well as the economic response that is likely to be forthcoming from policymakers. And reflecting that, the IMF acknowledges in its analysis that it's really important to pay attention to a potential downside scenario, which it also maps out and could well emerge over the course of this year. What is clear is that the immediate hit to the global economy is much more severe than the full year forecasts imply. At the moment, the hit to economic activity is anything in the region of 35–40% in most countries, perhaps even more in some. So there is an assumption that that is a temporary effect from lockdowns that are applying in many markets across the globe. Inevitably, against this backdrop, there is a real negative read over to the real estate sector. And it's really, not surprisingly, evident both in the occupier and in the investor segments of the market. On average, the Occupier Sentiment Index, which we compile through this survey, has dropped by about 28 points, and that's between the last two quarters, and that's across the whole universe of countries that we survey. And the Investment Sentiment Index has fallen by around 24 points. So fairly significant drops in both cases. Now, I just want to show this turnaround graphically so it's really clear. And hopefully you can see that the left-hand bars, refer to the occupier side and the right-hand bars to the investor side. So for turnaround, material in both cases. And just to give you the headline numbers there, so the occupier sentiment index as a reading is currently at -27. The investment sentiment index currently at -18. What is just notable, and I'm not sure it's a point of great encouragement, but worth pointing out, is that the current levels of these indices remain above those that were reached at the depths of the global financial crisis. So when a lot of people are asking me about the comparison, these numbers at the moment appear to suggest that the market is a little bit more resilient. And I think it's fair to say that at this point, at least, we're talking about a very different environment from that pertained in the aftermath of the GFC. Critically, this is not yet a financial crisis. That's not to say it won't become one, and that's something we need to be mindful of. Now, as you might expect, there are significant divergences in the results when they're disaggregated at a country level, although it's fair to say that they're all a little bit worse, if not significantly worse, than was previously the case. Interestingly, and I think it is an interesting point, the sharpest changes compared with Q4 2019 are actually in those countries where sentiment was strongest. So, for example, in some of the European countries, and you can see them largely to the left-hand side of the chart on your screens. So the readings for many of those European markets still not deeply negative, but they were strongly positive in Q4. So we are seeing significant turnarounds. The contrast to this is really what is happening on the right-hand side of the chart. And there you can see some pretty negative readings, both as far as the occupier is concerned and the investor market. But interestingly, and let's take as examples UAE, but also Hong Kong and Singapore, and to an extent South Africa, the readings haven't changed that much compared with the previous quarter. They were pretty downbeat as we moved towards the end of 2019, and indeed through much of 2019 in some cases, and have remained in that same ballpark. A little bit worse, but not significantly worse. And as you can see from the colouring scheme here, I've identified specifically a number of African countries and Middle Eastern countries with slightly different colours, just so they stand out from the other results in this particular chart. But I think that, you know, it's one thing looking as to where sentiment is today, and the real value of this survey is also really capturing what respondents feel about the outlook, and I think that's what makes this survey quite unique, the consistency between both the current sentiment and the forward-looking indicators. And I think what is a bit more disturbing about the results, and perhaps significant, is that those forward-looking metrics have also deteriorated quite sharply. And that would appear to me to suggest that people working in real estate who are responding to this survey are concerned that the pandemic is going to leave lasting scars on the global economy. And that's even with the radical and wide-ranging measures that have been introduced by governments around the world. My sense has always been that hopes for a V-shaped recovery was actually rather too optimistic. I think it's understandable that many people want to see that sort of turnaround, and I myself, perhaps sort of just on the outside of my range of thinking, hope that, you know, perhaps we could just get a very sharp uplift. But actually, I think it was always probably a little optimistic given the scale of what is going on. And I think there's a growing recognition that a tick-shaped rebound is much more plausible, with total output in all probability not returning to where it was at the beginning of this year until well into 2022. And I would suggest that this pattern for the evolution of the global economy is broadly consistent with the overarching message coming from this survey. So let's just look at what those forward-looking indicators are telling us. And if you look, I'm going to specifically focus on capital values. I will reference the rental picture and occupier picture, but let's just look at these numbers for capital values to get a feel for where things are. So overall, if we look at the global numbers, and that actually is the bars at the far right of this chart, you can see that it's talking about a decline in excess of 3% over the next 12 months. So that's the whole of the market. It's the whole universe and all sectors. And that is compared with an increase of around 1% that was anticipated at the start of this year. Now, for rents, the projection for this year, I haven't captured it here, but it is more downbeat still. And that isn't entirely surprising. When you think about the hit to economic activity that is currently underway, it is entirely predictable that the occupier market is going to be badly affected by the current environment, that this will be reflected in quite a significant fall off in tenant demand. And I think that helps to explain why the metrics around the occupier market are suffering even more than the ones I put up here in terms of the outlook for capital values and investor behavior. Looking specifically at the countries I've highlighted here in this particular slide, you can see that for the UAE, capital values are actually expected to fall by a little bit more, actually, I think, than the global figure, just around the 4% mark over the next 12 months, while respondents from Nigeria, I suppose in relative terms, actually look still quite positive. We're talking here about a modest increase over the next 12 months. But let's put that in the context of what those same respondents were telling us just a few months back. So if we look at the fourth quarter of last year, the expectation was for an increase in excess of 6%, so quite a significant turnaround. And even that 1%, I would suggest, looks fairly vulnerable as we move through the next few quarters of this year. Now, those were the sort of the headline numbers. If we were to sort of disaggregate a bit further, one of the key themes that is running through this survey is the role that COVID will play in accelerating structural trends in the real estate sector that in truth were already underway. Most notably, the lockdowns in many countries has provided further impetus for the rise of e-commerce. As restrictions are lessened, shops will reopen and customers will no doubt be eager to flock to them. But it's hard not to believe that the numbers choosing to use digital platforms to make purchases will remain at a higher level than in the pre-COVID world. The poor expectations for particularly secondary retail highlighted in this chart demonstrate the likely impact on this sector, although the slides imply that the effect will be more marked in the more advanced economies of the West, where rents and capital values could continue to see downward pressure, or I should say strong downward pressure. So just to clarify where that is visible in the charts, the secondary retail is that blue bar. Sorry, secondary retail is towards the right-hand side, and the global is the blue bar. So you can see that that is the standout reading from this chart. But it's secondary retail across the board is generally on the weak side, and it's a matter of degree as to where it plays out most strongly. I think the issues around the office sector are also quite interesting, and lots already been said. I'm sure you've all participated in conversations about the likely rise in agile working off the back of some of the changes that have currently been put in place during this crisis. And it's inevitable that businesses will look to build resilience against future pandemics by investing heavily in technology. That would seem to be a natural reaction to the current circumstances. And as a result, it would also be quite reasonable to assume that businesses will look to, at least at some level, reduce the scale of their footprint over time. This may not be something that happens immediately, and the impact may not be as quite as dramatic as what we might see in terms of retail. But I would imagine that over the coming quarters, we will continue to see evidence in this survey that the way in which the office space is used is changing, and that will be, again, particularly, I suspect, a feature of what happens in the secondary environment than in sort of perhaps the prime office space and those trophy assets, which I think will still have an important a role to play and still be sought after by business. There are, of course, going to be some beneficiaries from the trends currently underway, and again, well debated, nothing new. Logistics stands out as an obvious winner. Well-located sheds will be in greater demand. They are at the moment, as businesses are gearing up to respond to changing consumer preferences, and that will become more pronounced, I would suggest, inevitably as we move forward. And where we capture feedback around the multifamily sector, which at this point is only in a limited number of markets, unfortunately, I think the evidence is suggesting that that area is also proving particularly resilient. And perhaps it's a reflection just of the fact that housing, particularly in big cities around the world, remains a big challenge. It remains generally unaffordable, and there's a shortage of supply. So that's an area that is likely to remain sort of fairly strong as we move forward and hopefully move out of this current crisis. Now, we have included one or two new questions in the survey of late, and one of them is trying to build up a time series around macro risk for real estate investment, and that seems particularly relevant at this point. And not surprisingly, it is capturing the shift in the economic climate since the beginning of the year. The Q4 risk reading was about 3.5 on this scale of 1 to 6. And as you can probably infer from looking at it, the mean reading now has edged up, I should say, above 4. So it's pushed up a little bit. But actually, I mean, I'm surprised it hasn't gone up a bit further, which tells me that there's perhaps still a degree of, I suppose, optimism that there is an exit from this crisis. And it may not be visible at the moment, but that there are going to be opportunities, and that real estate is possibly still viewed as a good asset to be involved with, and that there will be significant, say, opportunities. It's about positioning oneself against the changing economic landscape. Now, before moving on to my final points, I just want to provide you with a flavour of the comments we've received from respondents from both the Middle East and Africa. Now, these are inevitably being handpicked, but I would tell you that they are pretty representative of the tone and the feedback from both areas. So really an emphasis on COVID, and that is, to be honest, actually something that we're picking up, as you might imagine, from markets across the globe. And interestingly, the UAE readings, they have been pretty negative for quite some while, and there are concerns that this is not yet the bottom of that market. We will obviously have to see, and I'd be very interested if anyone has any thoughts on that. So I would now like just to sum up, and in doing so, I would acknowledge it's pretty hard to know what the post-COVID world is going to look like. Unfortunately, however, I don't think it's just going to be a case of continuing from where we left off in February, and I think any optimism about that has sort of really dissipated. It will be really interesting to see whether there will be a further retreat from international cooperation and indeed globalization, or whether world leaders recognize that global challenges require global solutions. One positive, and I've already sort of just touched on that in that a couple of slides back, was really about sort of the value of real estate. And I think, as an asset class, it's still going to be viewed as being quite an interesting opportunity, particularly if one's focusing on the better quality and better located spaces. Remember, the returns from other instruments are pretty depressed as well at the present time. So perhaps a physical asset like real estate will continue to attract a lot of interest. That said, it would be short-sighted not to expect further disruption as businesses and consumers adjust to the new environment. And finally, my final point, we work with AFI members, that's the Association of Foreign Investors in Real Estate, specifically to try and capture expectations regarding the likely direction of capital flows over the next 12 months. This is an organisation, as many of you know, that has a focus on the US. And as a signal of the more defensive approach being taken by international investors, they, by a significant majority, are now expecting to deploy more capital in the US. Now, as recently as the last quarter, so Q4 of last year, there was a much more balanced view, with APAC and Europe expected to be recipients of large slugs of investment. So we've really seen a turnaround there, a move to a much more defensive position. And I think that probably does reflect where we are at this point in the cycle. Hopefully, as we move through this year, a little bit more confidence will return as the as economies around the globe begin to gather some traction, and that will provide the basis for a return of international monies around the world rather than being focused in such a defensive way. But clearly, and I started the presentation, the webinar, making this point, the risks on the downside are not insignificant, something highlighted by the IMF in its latest report. So I want to wrap up now, and I'm really eager to hear your thoughts or take any questions that you have relating either to the direct comments of mine that I've included in the survey, or some more general thoughts around real estate. I hand it over to you now. Do we have any questions? We have one here. Yeah, about Nigeria, and I mean, the point asking why the Nigerian market is standing out from the South African market and appears to have more in common with perhaps some of the European markets. I think it's partly a reflection of the dynamics of the specific economy, but it's also been reflected. And certainly, if I look at the data that we've been getting for Nigeria for some while, the numbers have been generally quite good. So Nigeria has been one of those markets that has, been able to sort of stand out from, perhaps it's, one of its neighbours and actually generate pretty, decent returns. And what we've found is that occupier demand in the country has held up through much of 2019. That investment inquiries are solid, and that provided the basis for the sort of numbers I've shown in this presentation. Are there any other questions at this point? Any other thoughts? Please type them in if there are. In terms of the UAE numbers that we've been receiving have been, there's a question here about the numbers being depressed and could it be a repeat of the last recession? The UAE numbers we've been getting have understandably perhaps been struggling, pretty weak for some while, and it's really been one of the worst performers. So in a sense, this has been more or less a continuation of that trend. What we have found is that much of the negativity until now was concentrated in the retail sector, and offices were struggling as well, but perhaps not to the same extent. But that this now seems fairly broad-based from what we're seeing. We're finding that development starts numbers are falling away, and on the back of that, the investment numbers are quite weak, and the expectations are pretty downbeat. We do also ask about what's happening in terms of foreign investment inquiries, and they've fallen away sharply. I'm not sure, looking at what I'm seeing about the UAE here, certainly in the feedback that we received and in the comments that we've received, that there's likely to be a turnaround anytime soon. So I mean, the fact that it's sort of the signaling so much to the right on so many of our charts looks to me that it really is likely to remain a weak market for a while to come. So I'm just getting another question here. This is about the nature of the recovery process in terms of real estate. I think that ultimately it's going to depend on how the economies perform and the global economy performs. And I mean, I certainly don't think we'll be looking at a quick recovery in real estate, and I've sort of implied that the next year looks like it's going to be pretty hard work, and that's certainly visible in the data we're receiving. And I am concerned that the risks on the downside to the global economy look to me to be certainly worthy of attention and not insignificant. And if that's the case, then if it undermines or continues to undermine the occupier market, it will inevitably have some bearing on him for investors. But I do stress that as far as from an investment standpoint, when one looks at the alternatives in terms of asset classes, there may be a lot to be said still for some parts of the real estate world. And I think that we can generalize in these terms, but actually, as with all investments, it comes down to the specifics. And I think that there will be opportunities within what is going to be quite a challenging period. I've got a question here now coming in about Bahrain and Saudi Arabia. And in terms of dealing with the first of those, the numbers for Bahrain that we've got in for Q1 have obviously been weak. If I was to just give you some headline numbers on just sort of in terms of the outlook, what we're hearing is capital values from respondents averaging something like 3 to 3.5% down over the next 12 months, and rent expectations down by a bit more. Again, very consistent pattern, 3.5 to 4%, with offices, actually prime offices, not looking particularly good on the rent side, and similarly on capital values. So the Bahrain story seems to be broadly consistent with the wider picture. And just having a quick look at what we're hearing on Saudi, the numbers actually look, when we got these ones, the numbers actually appear a little bit, slightly more resilient, and they're not as, occupier demand is down slightly, but it's down modestly rather than materially. And similarly with investment inquiries, obviously very specific nature to that market, but that is also reflected in expectations. So capital values actually pretty flat, rather expectations flat rather than falling, and similarly with rent expectations. So in relative terms, Saudi Arabia actually looking a bit more resilient than some of the other markets that I've been referencing. Do we have any final questions, as we are almost out of time? I'm certainly happy if there are any specific issues anyone has about the survey, for them to contact me directly, and then we can take that forward and I can get back to you individually with more detail about what the survey is telling us. But I think that is about it. So I hope you found the session interesting. Don't forget that we always want more participants in the survey. So if any of you are keen to contribute, and it really would be helpful to gather more and more insight, please do get in touch with me directly, and I will ensure that you are going onto our lists. Once again then, can I thank Colliers International, the World Built Environment Forum's premier partner, and also our executive partners, Glodden, Shanghai Orient, and Shanghai Oriental Investment Supervision Company. You can follow us on Twitter, Instagram, and LinkedIn, where you can receive news of upcoming webinars and catch up on any that you may have missed. And we have recently launched a World Built Environment Forum app, where you can access the latest innovative global thought leadership content across the built environment. A survey will appear on your screen at the end of today's webinar, and we would greatly appreciate it if you would take the time to complete and give your views on the webinar today. Until next time, can I say goodbye and thank you for listening in.